Here's what should terrify Washington. January 27, 2026. India and the European Union, 2 billion people, $27 trillion in combined GDP, signed a free trade agreement. Tariffs eliminated on 96% of goods traded between them. So here's the question. Why does this matter more than China's $630 billion Treasury exit? Think about it. China is an adversary, expected to leave. But India? A democracy, a strategic partner, the country Washington is courting as the counterweight to China. And Europe? The transatlantic alliance, America's closest allies. And on January 27th, they both announced, "We don't need Washington's permission anymore. This isn't a trade deal. This is a divorce." If this is your first time here, subscribe. Because what I'm about to show you, once you see it, you can't unsee it. Let me show you what triggered this. 2025. President Trump slapped 50% tariffs on India. Official reason? Punishment for buying Russian oil. India's response? Within 12 months, India signed free trade deals with the UK. July 2025, FTA, October 2025, Oman, December 2025, New Zealand, December 2025, the EU, January 2026, 5 major trade agreements, 6 months. Drop a comment if you think that's coincidence, because that's not coincidence. That's systematic risk removal. And here's the part that destroys the dollar system. India-EU trade, $136 billion annually. Now duty-free. India-UK trade, $35 billion, growing to $120 billion. India-EFTA trade, $20 billion, $100 billion in investment commitments. None of these deals require dollar settlement. None require Washington's approval. None tether India to U.S. financial infrastructure. Now let me connect this to what we documented in episodes 1 to 3. Episode 1. China exited $630 billion in treasuries. Episode 2. India exited $50 billion, moved 274 tons of gold home. Episode 3. Hidden buyers, UK, Belgium, Japan, absorbing the selling. But those substitutes are finite. And here's what the India-EU deal just did. When partners don't need dollars to trade with each other, they don't need to earn dollars by exporting to the US. When they don't need to earn dollars, they don't need to recycle those dollars into US Treasuries. The implicit bid disappears. And here's the scale. Hundreds of billions in annual trade flows that no longer generate dollar demand. And that number is growing fast. But understand this. Optionality isn't neutral. It's what you build when you're preparing to leave. Share this with someone who still thinks the dollar is untouchable. They need to see this. Here's what makes this catastrophic. This works only while volumes are small. But India-EU trade is projected to double by 2030, from $136 billion to $250+ billion. India-UK trade, $35 billion to $120 billion by 2030. When these corridors scale, and they will, dollar demand doesn't fade gradually. It steps down, structural drop, permanent gap. And here's what matters. Once trade infrastructure exists, it doesn't get dismantled. Even if politics improve, the alternative stays. The system has 4 to 6 years before that gap becomes unmanageable. Comment below. Do you think we have 4 years, or is this happening faster than projections suggest? Now let me show you something most analysts completely miss. This is the Belgium moment for episode 6. India has opened Rupee settlement accounts, Vostro accounts, for over 20 countries, Russia, Sri Lanka, UAE, multiple Gulf states. Here's how it works. India pays for Russian oil in rupees. Russia uses those rupees to buy Indian goods. Transaction never touches the dollar. Never passes through New York. Requires zero approval from U.S. Treasury. Current volume, $30–40 billion annually. Small, right? Wrong. Because the infrastructure is built. The legal frameworks exist. When India-EU trade doubles, these rails handle it. When India-UK trade triples, the capacity exists. This is what episode 3 called borrowed capacity for the dollar system. Except now it's alternative capacity for the non-dollar system. And capacity once built doesn't disappear. How are you positioning for a world where dollar demand is optional, not mandatory? Comment your strategy. Now let me show you exactly how big this already is. India-EU trade moving off dollar rails, $136 billion annually. India-UK trade, $35 billion projected to hit $120 billion by 2030. India-Russia through Vostro accounts, $40 billion India-UAE energy transactions, $80 billion, that's $291 billion in trade flows that no longer require dollar clearing. And when infrastructure exists, volume follows. When Indian exporters have duty-free access to Europe, they optimize for European markets. When European investors have protection frameworks in India, they invest in India. When both can settle in euros or rupees, they stop holding excess dollars. The system doesn't collapse, it's replaced. And once this volume exists outside the dollar, it never comes back, because exporters optimize for the system that doesn't punish them. Let me be precise about Europe's strategy. Europe isn't building 4 separate systems. Europe is building one thing: optionality. The ability to function if the US becomes unreliable. Digital euro? Not to replace the dollar, to have the option. Energy diversification? Not to eliminate US LNG, to have the option. Defense production? Not to abandon NATO, to have the option. But here's the thing about optionality. Once you have it, behavior changes. When you have one supplier, you accept their terms. When you have 2 suppliers, you negotiate. The India-EU FTA gives Europe a second supplier for $136 billion in trade, and it gives Europe optionality on dollar dependency. That's not anti-American, that's post-American risk. Most analysts are looking for collapse, a currency crisis. They're looking in the wrong place. The dollar doesn't die from shock, it dies from steps. Let me show you. Dollar's share of global reserves, 2000, 71% 2015, 66% 2020, 62% 2024, 58% not collapse, erosion. But here's what makes 2026 different. The pace is accelerating. Each new alternative, each Vostro account, each Rupee euro settlement, each non-dollar trade corridor removes structural demand. And when structural demand falls, the implicit bid for Treasuries falls. When the implicit bid falls, the hidden buyers, UK, Belgium, Japan, must absorb more. When they can't absorb more, the Fed becomes the buyer. Question for you. What percentage does dollar reserve share need to fall to before the system breaks? 50%? 40%? Comment your prediction. Up to this point, this looks slow. Trade deals, infrastructure, paper agreements. But this is the exact phase right before markets notice. Because here's how reserve currency transitions work. Phase 1. Alternatives are built. We are here. Phase 2. Volumes shift gradually. Phase 3. Markets notice. Panic selling begins. Phase 4. Fed forced intervention. We're not in Phase 3 yet, but Phase 1 is completing, and Phase 1 took 6 years, 2020, 2026. Phase 2 will take 3 to 4 years. Phase 3 happens in 6 to 12 months. Phase 4 is irreversible. If you're not tracking this, hit subscribe, because when Phase 3 starts, it's too late to position. Here's where this becomes catastrophic for Washington. The harder they squeeze, the faster partners diversify. Trump's tariffs, India signs 5 FTAs, NATO threats, Europe pursues strategic autonomy. Dollar weaponization, Vostro accounts proliferate. This is the paradox of weakening hegemony. When you're strong, coercion works. When you're weakening, coercion proves you're unreliable. Britain learned this in the 1930s, squeezed colonies harder. Independence movements accelerated. America is learning it now. But none of this solves the fundamental problem. $36 trillion in debt, $1.1 trillion in annual interest, $1.8 trillion structural deficit. Venezuela operations seized 17T in oil, but it takes decades to monetize. The India-EU deal doesn't eliminate U.S. trade, but it eliminates the implicit subsidy that came from dollar necessity. Comment below. How long before Washington realizes coercion is accelerating the decline? Let me show you why alternatives matter. In Episode 3, we documented that hidden buyers are absorbing China and India's exits. UK, $750 billion levering balance sheets. Belgium, $370 billion custodial camouflage. Japan, $1 trillion caught between yen defense and Treasury absorption. These aren't economic buyers, they're political buyers. And political buyers have breaking points. Currency stress forces selling, voter revolt forces reallocation. Bond market breaks forced liquidation. Now add the India-EU deal. $136 billion in trade flows no longer generating implicit Treasury demand. This is the moment systems don't collapse, they snap. Because when substitutes are stretched and demand disappears simultaneously, there is no stabilizer left. So here's the real question. Who breaks first? The substitutes or the dollar? I track these breaking points in real time. Hit subscribe if you want the early warning before CNBC reports it. We need to be honest. Strategic autonomy is aspirational, not complete. Europe still depends on U.S. security through NATO, U.S. technology infrastructure, U.S. financial market depth. The euro is 20% of global reserves. The dollar is 58%. That gap won't close quickly. But direction matters more than position. Europe isn't trying to replace the dollar immediately. Europe is building capacity to function without it if necessary. Once alternatives exist, they become options. And the India-EU FTA gave both parties that option. Comment. How long do you think the dollar stays above 50% of reserves? 5 years? 10? 20? 5 signals over the next 12-24 months. 1. U.S.-India trade deal. If India signs quickly, Washington offered major concessions. If it drags, India has no urgency. 2. Digital euro adoption, transaction volume on non-dollar rails. 3. Treasury auction coverage. Primary dealers greater than 20%. Hidden buyers exhausted. Direct bidders less than 10%. Private demand gone. 4. Vostro account volume. Rupee yuan euro settlement growth. 5. Reserve diversification pace. Dollar percent continues falling. Which signal concerns you most? Comment 1, 2, 3, 4, or 5. Here's what we haven't examined. When hidden buyers break, Episode 3 showed they will. When the Fed becomes the primary Treasury buyer, when monetization becomes permanent. What happens to the dollar itself? Not the economy, not trade, the currency. Because we've tracked the exits, the diversification, the alternatives. But we haven't examined the final stage. What happens when a reserve currency is being printed to fund its own government? That's the next fracture. And the signals are already forming. Systems don't fail when enemies attack. They fail when participants stop needing them. China exited. Adversary behavior, expected. India diversified. Partner hedging, trust broken. Europe built optionality, ally unreliability insurance. When swing states build alternatives, return is no longer the base case. The British didn't understand in the 1880s that their capital was building America while their empire hollowed out. Americans don't understand now that the system is being replaced, not by enemies but by partners. But by the time understanding arrives, positioning is already impossible. Subscribe to track this pattern as it completes. Share this with someone who needs to see it. Comment your biggest takeaway. Because systems don't fail in headlines, they fail in plumbing. And we track the plumbing. Flows don't lie. Welcome to Geopolitics of Money.